Hi, and welcome to our 5-minute tax update for October 2018. The aim of our tax update is to brief you on the most important tax development. So let's start. October has been a relatively quiet month with regards to tax developments. However, the long-awaited guide on benefits in kind was issued by the tax department. The guide, which is issued in the Greek language only and will apply from the 1st of January 2019, explains the tax treatment of certain benefits offered by employers to employees and to persons who hold or are deemed to hold an office. It is quite a detailed guide, so I suggest that you print the guide from the tax department's website and read it at your own time. The benefits in kind are divided into 3 categories. These are car-related benefits, provision of accommodation and use of company assets, and other benefits. The guide also provides for certain exemptions. We will briefly have a look at some of the most important benefits, leaving aside the details for you to read in your spare time. Benefits in kind relating to cars are divided into 3 categories: the use of cars, the use of vans, and reimbursement for the use of cars. With respect to the use of cars, a benefit in kind arises when there is an element of private use. The prescribed formula to be used takes into account the value of the car, repairs, and fuel. These values are calculated based on the car value and age and the prescribed percentage as shown in the table. The use of vans is much simpler, as the benefit in kind is set at a fixed annual amount of €500, irrespective of the van type, model, or the year of production. The value of the benefit for reimbursement to employees for the use of their own cars depends on whether the amount reimbursed is above or below a €3,000 threshold, as shown in the table. The second category of benefits describes the treatment of the provision of accommodation to employees and the use of company assets such as furniture, boats, aircrafts, and machinery. For both accommodation and use of assets, the benefit is set at a fixed percentage of the higher of cost and market value. For accommodation, it is set at 4%, while for the use of assets at 15%. Any other benefits not included in the first 2 categories fall in the 3rd category. Examples of these are the provision of assets at subsidized prices and the free supply or the sale of goods and services at a discount, such as travel, entertainment, meals, and transportation. Finally, the guide provides specific examples of exemptions such as the use of computers, childcare, subscriptions to professional bodies, and events for all employees. It is important that you familiarize yourselves with the guide, as there are many details which cannot be covered in this 5-minute tax update. Moving on to international developments, the tax bill on the Anti-Tax Avoidance Directive was finally submitted to Parliament. Cyprus must transpose certain provisions of the directive into law by the 1st of January 2019. We will briefly look at these provisions, however, these may be subject to change as the bill is discussed in Parliament. The interest limitation rule is introduced in an effort to discourage groups to engage in profit shifting through excessive interest payments between associated enterprises. The rule provides that exceeding borrowing costs will be deductible up to a maximum of 30% of the company's taxable earnings before interest, tax, depreciation, and amortization. This limitation will apply for exceeding borrowing costs that exceed €3 million in each tax year. It is still under discussion whether the limit will apply to each entity or at a group level. The general anti-abuse rule aims to tackle tax practices that have not been specifically dealt with through other tax provisions. This rule provides the power to the Commissioner to ignore non-genuine arrangements which do not have a valid commercial reason that reflects economic reality. Although the general anti-abuse rule is very similar to the existing Article 33 of the Assessment and Collection of Taxes law, it is considered that the new provision is broader in scope and easier to be enforced by the tax department. Finally, the controlled foreign company rules intend to reattribute the income of a low-tax controlled foreign subsidiary to its parent company. According to the rules, the member states of the parent company will treat an entity or a permanent establishment as a controlled foreign company if certain conditions are met. In principle, the Cypriot parent company will include in its income subject to tax the undistributed income of a controlled foreign company that is derived from non-genuine arrangements that have been put in place to obtain a tax advantage. The law provides for certain exemptions, which include controlled foreign companies that derive insignificant profits. We will close off today's tax update with a brief reminder of the upcoming deadlines. Subject to any late announcements for an extension, today is the deadline for the electronic submission of the 2017 personal tax return and payment of tax by salaried individuals and individuals who do not prepare audited financial statements if their gross income exceeds €19,500. This concludes our tax update for this month. Thank you for watching.